Stress test storytelling for drawdown scenario analysis made clear. Welcome. Today we'll turn stress tests into a story investors can act on. Good storytelling turns raw numbers into decisions by explaining what changes, when it changes, and why it matters. It builds investor confidence on risk because you show you've mapped the downside, not just the upside. Finally, it links scenarios to cash flow timing, not vague, bad, or good, but a calendar of impacts: when revenues dip, when costs spike, and when cash tightens. By the end, you'll present stress results that are clear, comparable, and directly tied to decision points. Start with a crisp scenario set: base, downside, and severe but plausible. The base is your plan. Downside is a meaningful setback. Severe tests resilience without being fantasy. Name triggers for each: rates, F, X, default rates, demand. For example, rates plus 200 bits per second, euro minus 8%, enterprise churn plus 3 points. Then state the time horizon and frequency: 12 quarters, quarterly. Investors think in timelines. Scenarios without clear labels, triggers, and cadence feel abstract. With them, your audience can track cause, effect, and duration. Be explicit. What changes versus the base case? List the deltas, not just the headlines. Volume minus 7%, price minus 2%, OPEX plus 3%, working capital days plus 10. Cite sources so assumptions feel anchored: market data, historical patterns, and expert views from sales, risk, or treasury. Keep units and sign conventions clear: BPS versus percent, currency, and whether a negative means outflow or decline. Example: gross margin minus 150 bits per second to 41.5%, USD revenue minus 5%. This reduces debate on mechanics and focuses attention on implications. Walk through the money. Bridge from EBITDA to free cash flow, so viewers see how profit turns into cash. EBITDA, right-pointing arrow. CapEx, right-pointing arrow interest. Right-pointing arrow taxes. Right-pointing arrow. Working capital, right-pointing arrow. Free cash flow. Explain drawdown timing, when and why you use credit lines. Q3 draw due to inventory build. Repay in Q1 after seasonal collections. Spell out liquidity runway and covenant headroom. 12 months runway at downside. Minimum cash buffer 8 weeks. Leverage covenant headroom 0.6x. Clear paths and timestamps. Let investors judge resilience, not guess it. Use one canvas for all cases. Keep the same scale for all scenarios so the severe case doesn't look harmless. Highlight deltas, not just absolutes. Free cash flow minus 18 million versus base is more meaningful than a lone bar. Add traffic light cues for thresholds: green above target, amber near limits, red when breaching. Example: leverage 3.1x, green 3.7x, amber at 3.75x, 4.2x, red, breach. Visual consistency speeds understanding and prevents optical illusions that hide risk. For each scenario, name the top 3 risk drivers, e.g., demand drop, input cost spike, refinancing risk. Pair them with concrete mitigants and triggers: pricing actions, OPEX cuts, supplier renegotiations, hedges, plus the trigger that activates each. Then state decision rules if metrics breach. If liquidity less than 6 weeks, freeze hiring. If leverage greater than 4.0x, pause buybacks. If interest cover less than 3x, execute Cost Program B. This turns fear into a plan and shows you own the downside. Keep language simple and precise. Use simple, active sentences like, "We draw $20 million in Q3 to fund inventory." Define key terms. Drawdown, money taken from an approved credit line. Covenant, a loan rule you must meet, like leverage limits. Runway, how long cash and credit last at current burn. Repeat key numbers with level, change, and date. Cash $45 million, down $12 million since Q2 by September 30th. Clear words reduce confusion and speed decisions. End with action. State your recommendation and next steps. Approve Hedge Program A and reduce CapEx by 10% in the downside. Specify data needs and decision timeline. Need board approval by October 15th. Require supplier quotes, updated FX paths, and AR aging by Friday. Offer a one-page appendix for details, assumptions table, scenario drivers, and the cash flow bridge. A crisp ask, clear deadlines, and compact backup. Turn your analysis into a decision today.